Hi, I'm Robert Sewell. I'm the head of the office investment team, Jones Lang LaSalle. I'm here with my colleague Andrew Ballantyne, who's head of capital markets research. And we're going to talk through the year ahead and what we see happening in the market.
Firstly, Rob, 2013 was a very active year for the office investment market. Indeed, the history books will record 2013 as a record year for office transaction volumes, with in excess of $13 billion worth of product trading. To put that figure in a global context, when you adjust for the size of the market, Australia was the third most liquid commercial real estate market in the world. Offshore investors remained active participants in our market, and overall they accounted for 35% of transaction volumes by value in 2013. Offshore investors were very active participants in the Australian market, and in 2013 they accounted for 35% of transaction volumes by value.
The big surprise for 2013, it was very much the year of the $400 million office transaction. There was 6 of them. They were created really by 2 major developers, being Laytons and Crowcon. New product, well leased, created by developers who wanted to sell these assets. So the question we're wanting to be answered is, what will this capital be doing this year? What will they be investing in?
In 2014, we'll see an extension of core mandates. We'll see investors willing to compromise on idiosyncratic risk factors such as whale and covenant quality. Furthermore, in 2014, we'll see new capital sources emerge. We're well aware of the well-documented entry of Chinese and Korean investors into the market, but we believe the next wave of capital will come from Middle Eastern sovereign wealth funds. However, in 2014, we will see the tactical disposal by some offshore investors who acquired product at the bottom of the capital value cycle in 2008 and 2009.
Right now, we have all the major offshore investors looking at Australian assets. We see this trend could change as markets such as the US and Europe, their physical markets will improve, growth will come into those markets. However, right now, I've never seen more capital in my entire career. The unlisted funds, our super funds, this combined with the offshore capital will put a lot of pressure on yields going forward. My prediction for this year is that because of this wider capital, we will see transactions occur in Sydney at below 6%. What concerns me is these investors last year were very much had an appetite for new well-leased product created by these developers. That product won't exist this year. They'll have to look at existing assets. They've actually ruled out markets such as Perth and Brisbane, and the money is focused really on 2 major cities being Sydney and Melbourne. So this year we'll see transactions in Sydney. We'll see prices setting new benchmarks that investors need to follow. And what they need to do is probably look further afield. They'll have to investigate markets like the non-CBD markets where last year we had a lot of activity. This will continue. We'll see different parts of the market, different risk profiles. I agree, Andrew, the stretch core will be very much in favour as some of these investors wish to maintain returns. In terms of volumes, it could be replicated this year, but it's going to be very much in those existing buildings. So the investors this year will be faced with having to take on assets at much lower returns. They'll have to take on older assets. They'll have to actually put their management expertise at work to maintain returns. They'll be taking on risk. So we see 2014 being a very different year to 2013. There'll be the volume sold, however, the assets bought will be very different.